Welcome to Fidelfolio Investments, where we're dedicated to helping you make better investment decisions. By deriving high potential strategies that combine the power of AI ML technology with human wisdom, our portfolio companies have delivered 400% higher profit growth and 72% higher ROCE than Nifty 50 companies in the last 4 quarters. In our latest investment webinar series, we reveal the key elements to Fidelfolio Investments' scientific investment philosophy. Keep watching to learn from our team how you can assess the life track record of a portfolio. Let's get started.
Can you share your life track record?
Yeah, there is a very common difficulty most investors face. My cousin, for example, who is elder to me, very well educated, works in a senior position in a multinational company, recently asked me to check if his investment performance is on track or not because he did not know how to assess it. And this is very common for most average investors. And it is not their fault either. There is far too much noise and too little guidance on what to look for. I know people who are otherwise intelligent, but believe stock returns should be evaluated every week or every month. Now, these are the same people who try to predict the outcome of a 5-match test series by looking at the first over only. But we also have others who look at investment from a long-term lens, and rightly so. But there is a risk that they won't know if the portfolio is on right track until it is already late. So imagine if you can track your investment performance only in 3 years or more time, then you won't know if the investment is on right track until it is too late. So there should be a mechanism to detect this as well. Now, most investment managers don't lay out a clear metric on which they should be assessed. This leaves the investor confused and the investment manager rather unaccountable. We like to tell our investors clearly how to assess performance of the great Himalayan compounder and Shivalik compounder. Shivalik compounder, let me remind, is the smaller ticket size version of the great Himalayan compounder with similar risk and return characteristics. We tell our investors to assess the performance in the same way that our research team does. That is tracking the profit growth and capital efficiency of the portfolio companies. So let's look at one of these metrics. Now that the fund is already 1 year old. Let's look at this chart. The blue bars represent total profit growth of portfolio companies of Great Himalayan Compounder, and the orange bars represent profit growth of Nifty 50 companies. In Q4 FY22, our portfolio companies grew their profit by 29% year on year, while Nifty 50 companies grew at 22%. In subsequent quarters, the growth of blue bars had been 30, 28, and 23% year on year, while that for Nifty 50, it has been 16, -2, and -12% YOY. So I want to point two major differences between the blue and the orange bars from this chart. One, the height of the blue bars. We see the blue bars are significantly taller than the orange bars. And two, the sheer consistency. That is, the height of the blue bars don't vary much, while orange bars range right from a high positive number to a very low negative number also. This means that our portfolio companies have grown their profits very robustly and with great consistency compared to Nifty 50 companies. Consequently, the average profit growth in last 4 quarters for Great Himalayan compounder companies is 28% compared to only 6% average for the orange bars. That is the Nifty 50 companies. Now, many of you might be thinking, why are we looking at profit growth of portfolio companies when the end goal is portfolio's investment returns? Now, see, the reason is very similar to the case when you look at how well your child is studying throughout the year, because you know that studying well usually results in success in exams. So studying well is a major driver of exam success. Similarly, profit growth is a major driver of portfolio returns in the long term. We have seen in our studies that portfolio returns are very close to the average profit growth of portfolio companies in at least 3-year investment period. That is why our research team is laser focused on this number only, and our investors should also do the same. See, our ML engines has been designed to identify companies that grow their profit by more than 20% annually. Growth in share price returns and portfolio returns is an outcome of It is an outcome of this profit growth. And we see this playing out well. We expect portfolio returns to become close to this number ultimately. But there is a second metric that needs to be checked too, the return on capital employed. Very simply put, this tells us how much money is to be reinvested into the company to generate this profit growth. Here again, the blue bars represent the return on capital of great Himalayan compounder companies, and the orange bars represent the return on capital for the Nifty 50 companies. Now, we clearly see that the blue bars are significantly taller than the orange ones, meaning our portfolio companies generate high profit growth for every rupee that is reinvested into the company. The average ROCE of portfolio companies is 36% versus 21% for Nifty 50. That is, it is 72% higher than Nifty 50 companies. So for every rupee that is reinvested into the company, great Himalayan compounder companies generate profit 72% higher than that generated by Nifty 50. So these two graphs combined tell us that since inception, it's been 4 quarters, these are live track record. Since inception, Fidelfolio great Himalayan compounder companies have grown their profits very consistently and with high capital efficiencies, which means they are able to reinvest their earnings and free cash flows into the business at very high return on capital, so that tomorrow again, they will generate very healthy profits and free cash flows without needing to burn or infuse too much money into their companies. So these are cash generative, super free cash flow rich companies that one can ever come across. So these were the fundamental performance track record. If we move to the next slide and look at the investment returns since inception, both Himalayan compounder and Shivalik compounder have had flat returns, very close to that of Nifty 50. Shivalik has slightly outperformed Nifty 50, and while Himalayan has slightly underperformed Nifty 50, both by a very small margin in either direction. Now, Nifty 50 has delivered 0% in the last 1 year. Now, what we believe and our research has shown is that in sufficiently long enough period, this number, that is this average profit growth, will get reflected, will get mirrored in the annual portfolio return of our strategy, given that these companies are able to maintain the very high capital efficiencies captured by return on capital.
Investment in securities market is subject to market risks. Read all the related documents carefully before investing. SEBI registration number, membership of BASL and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.